Well, hi there. My name is Jason Ayers, CEO of the Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, thank you for taking the time to watch our Portfolio Manager's Brief for December 2021. Well, looking back, stock markets continue to trend higher in October with strong gains in cyclical, defensive, value, and growth sectors because of better than expected corporate earnings. The major indices hit their peak in November before pulling back as the month proved to be a volatile one, ending with a more significant sell-off as headlines around the discovery of a new variant of concern, Omicron, triggered a month-end round of profit-taking, with investors contemplating the uncertainty of just how concerning this variant is. Now, at the time of the recording, not enough is known about this new variant as it relates to its transmissibility, severity, and most importantly, the effectiveness of the vaccine. And while this isn't the first variant of concern discovered, until investors receive some comforting and confident news, we can expect continued volatility in the markets. It's important that investors keep in mind that the unpredictability of this virus does pose a unique challenge to forecasting short-term market behavior. However, historically, viral mutations, while perhaps more transmissible, tend to be less severe. And when we consider increasing vaccination rates and boosters, as well as the ability for manufacturers to adapt and distribute vaccines relatively quickly, our focus is to stay the course while taking advantage of the volatility. Looking beyond the current uncertainties, our firm's view is that earnings estimates will continue to grow, pushing the markets higher. However, we don't expect to see this continue at the same pace as we have this year. What may be more troubling for the markets is Chairman Powell's November 30th comments on inflation when he suggested that it is appropriate in my view to consider wrapping up the taper of our asset purchases, which we actually announced at the November meeting, perhaps a few months sooner. And as this 15-minute chart of the S&P 500 suggests, investors weren't happy as we compare the new variant headline impact to the markets versus the Fed's press release. Powell continued to suggest that as the economy continues to reopen and spending rebounds, we are seeing upward pressure on prices, particularly due to supply bottlenecks in some sectors. These effects have been larger and longer lasting than anticipated, but they will abate. And as they do, inflation is expected to drop back towards our longer-run 2% goal. And the Bank of Canada shares a similar outlook as reflected in this chart. Now, the policies of the Bank of Canada and the Fed had started to diverge. The Bank of Canada had already began to reduce monetary stimulus, while the Fed has been taking a wait-and-see approach. But as mentioned, the Feds may taper sooner than expected, leaving fixed-income investors worried about incoming rising rates and what it will mean for their portfolios. Assuming Omicron proves to be less of a risk and focusing on Powell's comments, with inflation being less transitory than initially anticipated, the forecasts for the Bank of Canada and the Fed rates have shifted their anticipated rate hike timelines to the first half of 2022 for Canada and the second half of 2022 for the US. As GDP growth rates remain healthy, with a forecast of 5.5% growth in Canada by the end of 2021, 5% in 2022, and 2.5% by 2023. While bond yields have been on a steady upswing since the lows placed in April 2020, based on investors anticipating higher short-term rates from the Canadian and U.S. central banks and continued growth in both economies, recent headlines have driven rates back down as near-term growth expectations and forecasted rate hikes are called into question. Again, until we have more clarity on this new variant, we can expect rates to remain at the short-term lows with increased volatility. Now, as we've discussed in past portfolio manager briefs, energy prices are amongst the most volatile items in the consumer basket, which is used to measure the rate of inflation. The increase to 7-year highs witnessed over the last several months in oil once again has to do with demand heavily outweighing supply, driven by recovering European and Asian economies whose energy sectors were hit following the Delta wave of COVID-19, as well as OPEC's refusal to allow participating countries to ramp up production. That said, at the time of this recording, oil has dropped significantly as new variant uncertainty and the related travel restrictions call into question the anticipated demand for crude. Add to that a series of headlines that suggest a lower demand at the pumps and a build in inventory, and investors have all the reason they need to take profits. Regardless for the reason of this current sell-off, expectation has been that these high prices were likely temporary, as many of the contributing factors were not considered to be long-term. Although energy has been contributing to price increases across the board for consumer goods, the supply-demand gap for oil production was expected to be short-lived, as evidenced by the oil futures curve, which as of mid-November had been pricing in a discount of roughly 13% over the next 12 months, a move that we have just witnessed over a matter of days. Our firm goals and objectives are unchanged from last month, with the same focus on quality, reduction of interest rate exposure, and purchasing companies at a discount. While we are paying close attention to the headlines, we're viewing this current volatility as short-term noise and profit-taking until evidence suggests otherwise. Our move towards quality, and more particularly quality at a discount, should help weather the storm and position us well as we approach both a flatter equity market and a higher short-term interest rate environment. Our option writing strategies will benefit from the increased volatility, and our shift from tech, which has become more speculative, to low beta high value securities should act as a safe haven as we work through current uncertainties, while the sell-off presents an opportunity for entering into new holdings now trading at a discount. Our outlook for the rest of the year and beyond is a grinding market that will continue to increase, but at a slower pace. This is largely due to interest rate increases. While we took advantage of the earlier breakout in energy and oil by acquiring a small position, this was and is not a long-term strategy due to the volatility and uncertainty of oil prices, which, as mentioned, has suffered most significantly from the recent developments in the fight against COVID, the anticipated recovery timeline, and increase in inventory. In closing, we will continue to keep you updated as market conditions change and our outlook adjusts. And as always, for more insights, please check out our latest research report posted at www.croftgroup.com. And remember, be good to one another, stay safe and healthy, and on behalf of the Croft Financial Group, thanks for watching.